we are increasing our prices to match the structural part of the inflation, which is the inflation that we believe is going to stick in the longer run. And we have no problem at this point in time to pass on price increase. We do it very transparently with our customers, explaining to them why we do so. There is another part of the inflation which we believe is not going to stick. For instance, we're buying component on the spot market. Sometimes we have to buy them 20 times, 30 times more than what was their value back then. Or we have to buy containers, to ship our goods, and they are 4 times more expensive than what we used to pay for. And if you go on the spot market, it can go up to 10 times. We believe that these price increases or these cost increases, that part of the inflation is transitory, and we're not putting it in our price increases at this point in time.
It's pretty extraordinary that the cost increase to buy those things, based on spot pricing. Are you making any changes to the sort of way you procure materials and procure logistics arrangements to avoid ending up in a predicament like this in the future?
Yes, and to be completely clear on the subject, this is something that we wanted to do strategically because of the geopolitical tensions, that have happened in the past 2 to 3 years. So we had decided to restructure our supply chain because we have a very globalized supply chain. Today we are, sending across continents several hundreds of containers on a weekly basis. So this will need to be adjusted. What we're doing in the short term, we are diversifying our supplier base. That's one thing. We are also redesigning our products. It would have been very difficult to imagine in normal times, but we're redesigning our products to make sure that they integrate components that are more delivery friendly. But moving on, we have to think supply chains that are probably going to be more continental and less global. And that's what we're working on at this point in time also, but more for the longer run.
Eric, I just want to come back to today's price action. Clearly, investors are disappointed by the results. Signify shares are taking pretty substantial hit. They're down nearly 8% now. What comfort can you give investors around 2022 that may make them reassured, the ones who are perhaps selling today?
The level of volatility that you have in a quarter like Q3 is generating, a lot of surprises for everybody, and the market doesn't like surprises. At the end of the day, I think what is more important for us is the midterm capacity to adapt, which I think we have also shown in Q3, because the resilience of our results is quite, I would say, impressive in such a way when you look at the level of disruption that we have experienced. Look, what we said to the investors and in general, the company is sound. We are strategically extremely well positioned. We see a very high level of traction and demand on what is fundamentally strategic for us, which is connected lighting systems, our growth platforms. So we're moving in the right direction. Now, what happened in Q3 happened in Q3. We think it will be corrected in the coming quarters, and we'll be able to implement our strategy and continue to create value.